Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. What a week has passed. Today will be Wednesday, the 19th of July, the 19th of June, 2024. All right. So before we jump straight into our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. So before we jump straight into the short-term intraday technical outlook on the various cross-asset classes, that means i.e. the major stock indices, the major dollar pair, and the two commodities that I tend to cover, which is gold XAU/USD and West Texas crude oil. Let's have a recap what has taken shape yesterday in terms of key release of economic data, events, and as well as their respective price action movement on the various key cross asset classes. So let's take a recap on the economic data first. So yesterday, two highlights to economic data. On the highlight over here will be the RBA meeting, which is the Royal Bank of Australia, the Australia Central Bank. So the Australia Central Bank managed to actually did not actually surprise market expectation. They still maintain their benchmark interest rate unchanged, but however, they actually left it with a hawkish tilt yesterday. So during the press conference as held by the RBA governor, they actually discussed the possibility of a rate hike. All right. Okay, during yesterday's meeting, during the press conference, the RBA governor mentioned, and they also pledges vigilance on sticky inflation. And what did he mention over here is that it seems to us that there is a possibility that RBA might be the only major central banker in the world. That means among the other major developed central banker like the Fed, ECB, and even we talk about the Swiss National Bank. They may be only the central bank gearing towards more of a hawkish path. Why? Because they did mention that because of the state of the Australia economy is rather complex at this point in time, and due to the fact of elevated inflation, because over here is that they still keep mentioning about this word sticky inflation. All right, so at this point in time, the Australia Central Bank maintained the cash rate at 4.35%. And one of the reasons over here is that yesterday I do flash out, this is the monthly Australia CPI indicator, because after months of platooning up in December last year, the last 2 months, it continues to inch higher. Okay, so that actually also explains the fundamental rationale for them to actually have a much more slightly hawkish bias against the other central banks like the Fed, the ECB, and even the Bank of England, and as well as the Swiss National Bank. So the Australian dollar is one of the yesterday on the intraday basis, they actually the outperformer yesterday. So that shouldn't be surprised. Why? Because in my daily dose of market insight, I highlight the short-term intraday technical outlook on the Aussie dollar, which has flipped to a bullish bias on the intraday basis. I want to stress the word intraday because that's very short-term basis within a longer-term symmetrical triangle range configuration. Later, I'll touch more about that on the technical chart of the Aussie dollar, so you guys will have a better picture. What do I mean by that? All right, then another news flow, the highlight over here is on the US central bank. All right, the US central bank. So the US central bank, we do have a slew of Federal Reserve officials speaking yesterday. So no big change among the kind of a, I will put away that guidance that is given by them. So the guidance over here is very likely the same thing of the word patience. All right, nothing really changes from Fed Chair Powell speeches that was not speeches the press conference that was made last week. after the FOMC meeting. So yesterday's slew of Fed speak from these various officials, two keywords they mentioned: patient and as well as data dependent. And some of them actually supports Fed Kruger. He supports likely appropriate to ease later this year. And why do they support it or potential easing? Because some US key economic data has started to turn soft. So those who follow my daily dose of market insight yesterday, I do highlight the softness in one of the leading economic data will be the US consumer confidence that has started to ease off for the month of June, and that has been kind of translated to a actual weaker retail spending for the month of May. So yesterday, the US statistical board actually released their May monthly retail sales for US. So if you look at the retail sales for US yesterday that was released, it actually came in rather lackluster. So on the year-on-year figure, it came in at 3.6% year-on-year, way below 2.7% that was printed in the month of April, pardon me. And even the 2.7% for the month of April was revised downwards from 3%. So if you look at the trend of the US retail sales data, okay, it has been slowly inching downwards since March this year in terms of this growth trend. It's still positive, but the growth trend has started to slowly get softer. All right, so that actually also gel in line with the weaker state of consumer sentiment data that I highlighted to you all earlier yesterday. So maybe let's have a quick look at the consumer sentiment. Okay, yeah, this is what I mean, consumer sentiment. If you open up the consumer sentiment, okay, it also showing signs of easing off as well since March, right? Pretty much in line with the actual consumer spending data. So another thing, why do we need to monitor retail sales and consumer sentiment in US? Because retail sales spending takes up close to 2/3 of the US economic growth. All right, 2/3 rather, because US itself is not a manufacturing hub. Instead, okay, despite the fact of this ongoing reshoring that is coming back into US, close to 2/3 of the economic growth are still pretty much dependent on consumer spending. So with a lackluster or softer growth in retail sales that's being reinforced by a weaker soft spot in consumer sentiment, that actually still supports the ongoing notion that at least one potential interest rate cut by the Fed before 2024 ends. So that actually keep this one interest rate cut narrative still alive, which is still pretty much supporting this ongoing, at least a bit of liquidity pumping into the risk assets that supports the medium-term uptrend of the major US stock indices. All right, so these are the key economic data news that took shape yesterday. So now let us now move on to the fundamentals and the intermarket dynamics, okay, of across the major cross assets classes. So let's start with the US dollar first. All right, so if you look at the US dollar, the dollar index yesterday has starts to turn traded sideways. If this is the daily chart of the dollar index. So if you look at the chart of the dollar index over here, after the push up from the start of this month over here, it starts to be a bit lackluster yesterday, struggling at this resistance level of 105.45. All right, 105.45, but it's still holding above the 50-day, the 20-day, and the 200-day moving average. All right, so one of the reasons over here is that why is it still holding above the 50, the 20, and the 200-day moving average is due to the fact that there are two conflicting factors that happening right now. One, the dollar tends to be a safe haven bid as well. One of the safe haven, we call it a currency to actually where short-term speculators tend to actually get attracted towards it due to any major risk-off event that is taking shape globally, and this risk-off event must be pretty much significant that could impact a significant systematic risk in the financial markets. And one of the key ongoing and unfolding systematic risk event that is taking shape right now is in Eurozone. So what is it? It's actually due to this ongoing right-wing European political parties that is gaining a foothold in the European parliamentary election. And right now, in this upcoming end of June, there will be a France legislative snap election that is being called by the current president Macron. And right now, based on the current poll, the right-wing party is actually gaining a significant lead over Macron's centralist party in this upcoming France localized, we call it legislative election. And how do we see the risk that is being played off is by plotting the yield, the sovereign bond yield of the spread between the 10-year France sovereign bond yield against the 10-year German sovereign bond yield. So what we could see over here is that the red line over here, you see a big spike up last week in the sovereign spread, the spread between the 10-year France sovereign bond yield over the 10-year German sovereign bond yield. So this is something like a major bullish breakout. So what it means over here is that market participant is now assigning this higher risk towards the France government bond because the yield is being bid up. That means a sell off in French bond that lead to a spike up in the French sovereign bond yield. So what it means that over here is that there is still this ongoing geopolitical risk premium that is being attached to the French economy that could also spread out wider to the European wide economy as well. So that actually explained recently why the euro dollar actually tumbled. All right. So that is also actually supporting the ongoing dollar strength that is being seen, that is still resilient, that is holding above the 20-day and the 50-day and the 200-day moving average. But in the short term, it start to see a bit of pullback at the 105.45 level. All right, so this potential pullback on the 105.45 level could be also be caused by the softening of the 10-year US Treasury bond yield that continue to actually plummet or refuse to break above the 200-day moving average and the 20-day moving average over here that is acting as a resistance at around the 4.4% level. All right, so yesterday the US 10-year yield gets softened again, so it seems to us that it is now inching downwards towards the trajectory to hit the next medium-term support, which is the medium swing low of 4.05%. Okay, 4.05%. So right now, the US dollar right now is being kind of conflicted by these two dynamics that are at play. If there is no risk-off event that is unfolding right now, or geopolitical heightened risk event, or an increase, I'll put it away that an increase in geopolitical risk premium in Eurozone, strictly looking at the US 10-year Treasury yield, potentially it could actually lead to a weaker dollar. All right, but however, due to this ongoing rising geopolitical risk premium in Eurozone, by this upcoming French legislative election that is going to be held on the 30th of June, that causes the dollar to get bid up as well. All right. So we now can't solely just look at the US 10-year Treasury yield as an intermarket factor or dynamic against the dollar, the US dollar story. We now got to take into account of geopolitical risk premium that is still unfolding in the Eurozone economy. All right, so this one stress on the FX market. And on top of that, what happened in the major US stock indices yesterday was the S&P 500 managed to hit a fresh all-time high at 0.25%, but almost unchanged on the Nasdaq 100. The Dow Jones Industrial Average added 0.15% due to we call it outperformance in the key financial and healthcare stocks yesterday, followed by the Russell 2000, almost the same magnitude as the Dow Jones Industrial Average, added 0.16%. So if you look at the heat map of the S&P 500 yesterday, what you could see is there are more greens than red. But what's interesting over here is that there is actually a rotation play that is going on among the 7 mega cap stocks. Over here, we see especially the stocks that are related to AI, Microsoft, Apple, Google, and Meta. We start to see yesterday they actually sold off, and this sold off over here is being kind of inversely translated to a outperformance of Nvidia that is gaining 3.51%. And due to this rotation play among the mega cap stocks that are heavily concentrated on AI related team play, Nvidia benefited yesterday, and that actually led Nvidia to surpass Microsoft as the #1 component stock inside the S&P 500 and the Nasdaq 100. So how do you see that? If you go to trading view over here, okay, you're able to plot the current total market cap value of the individual mega cap US stock. So we could see over here is that Nvidia now has a market cap of 3.335 trillion that surpassed Microsoft of 3.31 trillion yesterday. And if you look at the rise of Nvidia has been truly amazing. Since 19th of April, notice that this steep push up in its market cap weight, the increase just within a span of within a span of I would say 2 months. Okay, you look at the tremendous increase. If I were to draw that, okay, where is the line? Yeah, over here. Okay, 70% increase in market cap within 2 months. All right, so most of us will start to get a bit worried that Nvidia itself has a very significant impact on the major US stock indices due to this push up. And some of us, if you look at social media, has been drawing similar parallel with Nvidia against previously Cisco during the 1999 dot-com bubble bull run. All right, so to actually see, yes, there could be a possibility, but in my opinion, if I were to look at Nvidia rise itself over here, uh, the AI technology is still new, and we got to take things one step at a time. And yesterday I do highlight that the market breadth of the S&P 500, the Nasdaq 100, due to the percentage of component stocks holding above the 20 and the 50-day moving average, has continued to be in a healthy footing. Quality-based factor ETF on the S&P 500 now has staged a bullish breakout. So there could be still possibility that we hasn't reached a major peak point in the S&P 500 yet, and even the Nasdaq 100 to say that this is a level where potentially the Nasdaq 100 or the S&P 500 could shape a 20% potential decline or the start of a major market crash. If we start to see with the fact that heavily concentrated return has been centered on Nvidia and its steep rise as well in the last 2 months. And if you to look at the technical chart of Nvidia, okay, let's do so. This intermarket analysis of why, because Nvidia now has a significant influence on the market cap weight. It's being #1 right now, and due to its rise, it could impact the movement of S&P 500 and the Nasdaq 100 significantly as well. So it's good for us to do a bit of intermarket relation between Nvidia and the rest of the market. So now let's take a look at the technical chart of Nvidia. All right, so for Nvidia, you could recall over here is that right now it's trading less than $1,000. Nothing surprising, because of the stock split that took shape on the 10th of June, not too long ago. So over here, what we could see is that this is a log chart. There is still no signs of any topish configuration yet. All right, I mean, price action going to trade within this major ascending channel since the low of 13th of October. The top of the channel, yes, is reaching at 15150. Perhaps around this 15150 area here, we may see a bit of pullback taking shape with key support at 9510 level. This is the medium-term key support level to watch out for. It also correspond to the rising 50-day moving average. And if you look at the daily, okay, let me reduce this. Yeah, the daily RSI, yes, is overbought. All right, it's overbought. but it hasn't reached the current previous extreme overbought level. Oops, sorry. Okay, let me do a proper one. Okay, it's a bit laggy, so I can't. Seems to me I can't. The things, some of the function get hang very easily right now. Okay, it hasn't hit the extreme overbought level yet, and yes, it's overbought, but it's going to shape a series of higher high. There's no bearish divergence at all. That means there's no lower high in line with the price action. In line with the price action of that higher high and higher high that is shaping out on the within the major ascending channel towards the upper limit at 151.50. So net overall, this is the daily chart. So what you could see over here is that it seems to us, based on the current technical elements of NVIDIA, there is no signs of a medium term or major bearish element that has kind of surfaced. Yes, there could be some signs of a minor, what I call it, a pullback at 151.50, but no bearish major topping configuration that's being cited yet. So that actually supports the ongoing bullish trend, both on the short term and the medium term basis, as well as the major trend, I mean short, medium term and major trend of the S&P 500 and as well as the Nasdaq 100. All right, so that is the intermarket correlation between NVIDIA and the major US stock indices of S&P 500 and the Nasdaq 100. So with that, that pretty much sum up the short, the what we call it, the more longer term fundamental and intermarket dynamics of the key cross asset classes. So with that now, let us now immediately jump straight to the short-term technical outlook, starting with the FX market first. So before we start on the euro-dollar pair, let's have a quick look of the 5-day rolling performance as of today while we are speaking, 19th of June. Okay, so very interestingly, right, we in our expectation that we highlighted yesterday, where we flipped to a short-term bullish bias on the euro dollar, the Aussie dollar, the sterling dollar. That means indicating some signs of a dollar strength pullback on an intraday basis, which it indeed takes shape. So yesterday, the dollar major against the rest of the currency starts to actually shape a, give me now, starts to actually do a bit of deflating over here. All right, deflating, but overall it's still going to trade in a sideways range movement, with the fact that the dollar is now weakening against the Swiss franc. Okay, the most. Okay, one of the reason why, because number one, the SMB, which is the short form SNB, Singapore, Norway, Bangkok SMB, the Swiss National Bank, short form for it, is going to hold its upcoming quarterly monetary policy meeting on tomorrow, 20th of June. And very likely they will stand pat after their historical rate cut earlier in March. So for SMB, they don't hold their monetary policy every 1 or 2 months. They held it every 3 quarters. So due to the inflation deceleration trend in Swiss, very unlikely the Swiss central bank will tilt towards a much more hawkish bias. But why the reason that the Swiss managed to actually benefiting from, why the Swiss is actually so strong at this point in time, despite the fact that the Swiss central bank will not shift to a hawkish bias, but rather towards the dovish side of the story. Why? Because of the deflation trend in the in Switzerland, but it's more likely not related to monetary policy of SMB, but more related to the ongoing, we call it geopolitical risk premium that is rising in Eurozone. All right, so given the fact that the euro, the Swiss is also part of, very close to the European country, so any potential rise in geopolitical risk premium in Eurozone will also potentially see a safe haven bid in the Swiss franc, especially via the Euro Swiss currency, which is also tumbling right now as well. So that actually explains the strong movement of the Swiss against the dollar. All right, so now let us now straight away jump into the individual short-term intraday technical outlook on the European currency, starting with the euro dollar first. All right. Okay, so before that, let me expand my screen so that you guys could see. So euro dollar over here. So euro dollar, for those who recall, yesterday we do have a bullish bias. We flipped to a bullish bias yesterday for our short-term intraday technical outlook, holding above the key short-term pivotal support at 106.90 level, 106.90 level. So with that, the price action actually managed to rebound, but so far it didn't actually surpass the first resistance at 107.45. Okay, it hit that level during the start of the US session and it starts to trade sideways. So I don't want to adjust my short-term pivotal support to be so higher or tighter. So instead, I will highlight a potential first support level to watch for today. Okay, at 107.10 level, 107.10 level. So as long as any minor pullback didn't surpass 1.0690 short-term pivotal support, we'll still maintain that short-term intraday bullish bias on the euro dollar. Above 1.0745 expose the next near-term resistance zone of 1.07730, 1.0790. We also confluence with the 50-day and the 200-day that is also acting as a resistance zone as well in this area over here. Only an hourly close below 1.0690 will invalidate this short-term intraday bullish bias for this ongoing mean reversion counter trend rebound scenario to see further potential start of further potential weakness to expose the next near-term support level at 1.0656. A breakdown below it sees 1.0620, 1.0600 level. Sterling dollar next. So the sterling dollar also continues to trade higher yesterday. Okay, it's going to trade that higher yesterday, holding above this 1.2645 short-term pivotal support level. So with that, I'm going to adjust it slightly higher. So very clearly, this is indeed a key support level to watch, at least in a short-term intraday basis. All right, over here. Okay, so adjusting it slightly higher. Okay, give me a minute now. It's a bit laggy right now. Okay, this is sterling dollar. Okay, to 1.2660. All right. So as long as 1.2660 holds, we'll still maintain that short-term intraday bullish bias for this minor counter trend rebound scenario to play out. First near-term resistance to watch will be at the 12740 level, which also corresponds to the 20-day moving average. Above it exposes 128 figure level. Only hourly close below 12660 will invalidate today's intraday bullish bias to see another round of potential weakness on the sterling dollar to expose the next near-term support at 12605, which corresponds to the 50-day moving average. Below it says 1.2565, which also correspond to the key 200-day moving average next. So that's for the sterling dollar. Asia Pacific currency, let us look at the Aussie dollar. So the Aussie dollar floated up as expected with expectation and hit the resistance level that we highlighted at 66.65 level. So right now, given that the hourly RSI is at the overbought level, but one thing positive that there's no signs of an exhaustion because there's no bearish divergence. The RSI going to shape higher high in line with price action. So given that it has already reached its overbought condition, potentially there could be a minor pullback. All right, so the pullback level to watch over here, the first support level to watch in terms of the pullback could be this level here. All right, this potential okay, one second. Yeah, this, sorry. Yes, this level here. Okay, this minor range of pullback 66.55 followed by 66.45. Okay, this potential pullback area here, but I don't put it so tight over here because slightly below it we do see the 20-day moving average that is also confluencing with the former inverted V-shape pullback. Then thereafter we see a bullish breakout over here at 66.30, and if we do that entire Fibo retracement of this last push up since Monday's swing low to the current intraday high, that also corresponds to the 50% Fibo retracement. So given that there's much more technical elements that is confluencing at 66.30, I'll be using 66.30 as my short-term pivotal support level. In the case of any pullback, potentially there could be a pullback taking shape. Why? Because of the overbought condition on the hourly RSI. So as long as this minor pullback didn't surpass below 66.30, we'll still maintain that short-term intraday bullish outlook on the Aussie dollar within its medium-term symmetrical triangle range configuration. Next resistance to watch will be the upper limit of the symmetrical triangle range configuration at 67.10, followed by the key medium-term resistance at 67.30 level. Only an hourly close below 66.30 will invalidate this short-term intraday bullish outlook to see it floating down towards the lower limit of the symmetrical triangle range configuration. But the near-term support to look out for in the first step will be from an intraday basis will be at 65.90/65.80, which is so confluence with the minor swing low area of 17th of June and 11th of June, as well as the rising 50-day moving average. A breakdown below it exposes the key 200-day moving average that is also confluencing with the minor graphical support area of 65.40, which is defined by the class congestion area of 2nd of May. So why do I keep saying the Aussie dollar is still trading within a medium-term symmetrical triangle? Very quickly, for those who are first time following my daily dose of market insight, let's quickly look at the daily chart of the Aussie dollar. Oops, sorry. Okay, so what we could see over here, since the low of 13th of October, it has been, price action has been trapped by this ascending trend line and a descending trend line from 3rd of January. So this is actually what I mean by a symmetrical triangle range configuration. And right now, at most, the resistance to watch will be at 67.10, potentially the upper limit of the symmetrical triangle range configuration. Unless we see an hourly close, a daily close above it at 67.10, then more or less we could have a firmer, clearer picture that it start to shape a bullish breakout from this symmetrical triangle range configuration. So as long as it remains below 67.30, price action will continue to actually oscillate within this symmetrical triangle range configuration from a higher time frame perspective. All right, so that's what do I mean by that? Why Aussie dollar is still evolving within a medium-term range configuration. Very quickly, the next one to highlight over here will be the dollar yen. So the dollar yen continues to trade sideways. Yesterday it hit the first resistance level that we highlighted at 15, the upper limit of it, which is 158.30 level. Then thereafter it continues to trade sideways. So over here, right, I'll be still using this level 156.60 as my short-term pivotal support level because it also corresponds very closely to the 20-day moving average as well. So still no change, 156.60 short-term pivotal support level. A break up above 158.30 potentially exposes the lower limit of the longer-term pivotal resistance zone at 159.50 level. So what's 159.50 level is the key medium-term swing high area of 29th of April over here. Okay, only an hourly close below 156.60 will invalidate today's intraday bullish bias. So we still maintain that intraday bullish bias on the dollar yen. An hourly close below 156.60 will invalidate this potential short-term intraday bullish bias to see another round of choppy movement to expose the next near-term support zone at 155.80/40, which is confluencing with the 50-day moving average. A breakdown below it exposes the minor swing low area next at 154.60. Okay, so that sums up the short-term intraday technical outlook on the FX, the dollar FX pair. So what we could see over here is that based on the current technical element, potentially there could be still some form of intraday dollar weakness taking shape, with the exception of the dollar yen. Okay, now moving on will be the major stock indices. Okay, let us kickstart with the Asia Pacific indices first, starting with the Japan 225. So the Japan 225, yesterday we actually flipped to a neutrality bias over here. So kind of neutral between 30 this level here, 38,550 and 38,240 level. So during to yesterday's US session, it managed to clear above the upper limit of the neutrality zone. So with that, and it hit the first resistance, which is the 20-day moving average, before trading back down again. So with that, we will flip to a short-term bullish bias using the 50-day moving average as well. That also correspond to yesterday's breakout level of the new upper limit of the neutrality zone. At 38,500 now will be my short-term pivotal support level that I will have on. Okay, what's going on? Okay, sorry. Okay, give me a minute. The screen has frozen again. Okay, on the Japan 225. So as long as 38,500 short-term pivotal support holds, we will flip to a short-term intraday bullish bias within this complex range configuration that the Japan 225 continue to play out since the high of 20th of May. First resistance to watch for sure will be at 38,750. Above it exposes 39,020. Potentially next will be coming in at 39,290, which is the minor swing high of 11 on June and 30 of June. Only an hourly close below 38,500 will invalidate today's intraday bullish bias to see it floating down towards the lower limit of that range configuration. Next support level to watch will be at 38,240, followed by 37,960 next. So that's for the Japan 225, i.e. Nikkei 225. Okay, moving on, next will be the Hang Seng Index, or the Hong Kong 33. So the Hong Kong 33, yesterday we were neutral between 17,800 and 18,155. So in today's Asia session, it managed to stage a breakout above the upper neutrality range. Okay, so with that, we'll be flipping to a short-term bullish bias. So over here, so I don't want to target it so tight at 18,155 as my short-term pivotal support for today. So they will be like a first. So this zone over here, okay, give me a minute. It's always very lagging right now. Every time I try to draw something new. Okay, so this will be the first support level to watch in any form of a pullback. So there could be a pullback taken shape at least right now. Why? Because the hourly RSI has really went up to the overbought condition. All right, if we hit the overbought condition, there could be a chance of a pullback in first step first. All right, so as long as this pullback didn't break below yesterday's swing low area at 17,780, we will flip to a short-term intraday bullish bias. First resistance to watch where the pullback may take shape is at 18,380. Above it exposes the next near-term resistance at 18,730. However, an hourly close below 17,780 will invalidate today's short-term intraday bullish bias to see another round of weakness to expose the next near-term support at 17,600, followed by 17,170, which is also confluence with the 200-day moving average. Okay, so that's for the Hang Seng Index, i.e. the Hong Kong 33. So moving on will be the European stock index, the German 30, or the German DAX. So the German DAX over here continues to be restricted by this resistance that we highlighted yesterday at 18,240 level. All right, and what we could see over here is that the RSI also has started to inch downwards as well. So we adjust slightly the short-term pivotal resistance lower, yes, from 18,380 to 18,240 for today, given the fact that the price actually has started to shape a lower high right now. So 18,240 short-term pivotal resistance on the German 30 still maintain that short-term bearish bias, intraday bias on it. First support level to watch will be last Friday's minor swing low area at 17,990/17,930. A breakdown below it exposes 17,850, followed by 17,750 next. Okay, which is this congestion area over here of 19th of April. Only an hourly close above 18,240 will invalidate today's intraday bearish bias, not bullish bias, bearish bias, to see the continuation of this counter trend rebound extending to expose the next near-term resistance at 18,380, which conversing with the 50-day moving average acting as a resistance. Above it sees 18,520 level. All right. 18,520, yeah, resistance level. Okay, so that's for the German 30. So now on to the US major stock indices. So before we touch on the US Wall Street 30, just a gentle reminder that the cash US stock market will be closed for a public holiday for today. All right. So yesterday the US Wall Street 30 managed to hit the first resistance level at 38,875, and what we could see over here is that the very clear bearish divergence has been formed on the hourly RSI, so indicating to us some form of momentum weakness, at least in the short term. So still no change, still using that upper limit of this potential ongoing ascending triangle range configuration that is still in play since the low of 13th of May. Higher swing low, but similar highs you could see over here. So this is a impending potential ascending triangle as seen on the hourly chart. So it's a minor ascending triangle. So still using the upper limit of this potential ascending channel as my pivotal resistance for today, 39,130. Still maintain a short-term bearish bias within this ascending triangle range configuration, potentially floating down towards the lower limit of the ascending triangle range configuration. Near-term support level to watch in first step will be at 38,560, followed by this zone over here, which is close to the ascending triangle lower limit at 38,420, 38,280. Only an hourly close above 39,130 will invalidate this short-term intraday bearish view to see ascending triangle bullish breakout. Next resistance in first steps to watch out for will be at 39,390, followed by 39,600. So that's for the US Wall Street 30. Lastly will be the Nasdaq 100. So the Nasdaq 100 continues to remain pretty resilient over here. So yesterday it didn't break above the first resistance that we highlight at 19,990. So right now I don't want to change anything over here. Still using this 19,610 level as my short-term pivotal support level, because there could be still a chance of a minor pullback taking shape. Because it's now still trying to actually flirt around the 19,990 level, and it can't break above it yesterday. So there could be in first step a minor pullback taking shape. Okay, so I don't want to tighten it so tightly. The pivotal support level 19,610 will still be my short-term pivotal support level, which is the lower limit of this steeper ascending channel that I drew from the low of 31st of May in gray over here, this line. Okay, you can see. So as long as this 19,610 holds in any chance of any minor pullback, we will still maintain that short-term intraday bullish bias on the Nasdaq 100. Next resistance level to watch will be at 20,120/155. Not 2000, 20,120/155, 20,260 level, all defined by a cluster of Fibonacci extension. Only an hourly close below 19,610 will invalidate the short-term bullish bias to kickstart a much more pronounced, steeper minor pullback scenario, exposing the next near-term support area at 19,480, followed by 19,240, 19,100, which correspond to the rising 20-day moving average as well. Right, so that sum up the short-term intraday technical outlook on the major stock indices. Let's move on to the commodities market, starting with the gold, XAU/USD. So for gold continues to be trapped within this neutrality range that we highlighted yesterday. So due to its mixed technical element, and what we could see is that the RSI also starts to bank off from a descending resistance as well over here. So net overall, it could still continue to evolve in a sideways range configuration within these two neutrality range, within this neutrality range that we highlighted yesterday in dark blue. So still no change, maintaining a neutrality stance on gold XAU/USD between 2,338 and 2,300. Only a bearish breakdown below 2,300 will unleash another form of minor corrective pullback leg to expose the medium-term support level at 2,280/2,270. All right, so if you see an hourly a breakout above 2,380, then it's a bullish breakout within this neutrality sideways range to allow it to float up to 2,345, followed by the minor swing high of 7 on June at 2,386. All right, so that's for XAU/USD gold. So moving on, next will be the West Texas crude oil. So the West Texas crude oil continue to be firm yesterday as well. Still recall yesterday we flipped to a bullish bias because of technical elements has starts to show a very clear bullish reversal tipping point on 4th of June and 5th of June as price action shaped that V-shaped recovery right at this major ascending trend line that I drew from 20th of March last year. All right, and it also closes. So yesterday price action managed to stage a daily close above the 50-day and the 200-day moving average. So indicating to us that is a ongoing bullish medium-term reversal that is taking shape. So what do we see on a short-term intraday basis? So now flipping on to the hourly time frame chart over here. So the hourly time frame chart right now is almost coming close to the second resistance that we highlight at 81.90 level. All right, so what we could see over here is that potentially right now there is a bearish divergence that has started to form. Okay, there's this bearish divergence that has started to form on the hourly time frame. So with that, right, there could be a risk of a minor pullback that is taking shape today, and given the fact that it's coming close to the second resistance that we highlighted yesterday. So with that, right, I'll be using this 81.90 here as my short-term pivotal resistance, and we will flip to a short-term intraday bearish bias for this ongoing potential mean reversion, short-term minor mean reversion decline or pullback scenario that could play out. Why? Because of this bearish divergence that's being seen on the hourly RSI, indicating to us that yesterday push up is a bit overstretched, so that is could be potentially due to a pullback. So pullback level, support level to watch over here for today will be this zone here. Okay, at 79.45. Okay, let me put it in text form so that you guys could see clearer. 79.45/78.90. Okay, this level over here. So if this level starts to give way, that potential minor pullback could actually transform into something much more deeper to expose the next support level at 77.60. We're also confluencing with the 20-day moving average acting as a resistance as well. But however, if we start to see a price action bullish breakout above 81.90, that means we have an hourly close above it, then this short-term intraday bearish bias for that minor mean reversion decline pullback scenario to unfold will be invalidated. So after 81.90, it will start to expose the next near-term resistance level, okay, at this area here. Okay, at 82.90, followed by the swing high of 83.60 level as well. And if you do the ascending trend line, taken from the start of this bullish reversal of 4th of June, oops, sorry, it should be the channel. Okay, it corresponds to the upper limit, close to the upper limit of this channel over here. Okay, if we start to continue to evolve going forward. All right, so with that sums up the short-term technical outlook of the key cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data points to look out for today? So for today's economic calendar, if the key data point to highlight over here, the key economic data release will be at 2 p.m. Singapore time. That is related to the sterling pair, will be at the release of their inflation rate data at 2 p.m. So market is expecting a further deceleration trend to 2% to 3.5% in the year-on-year inflation rate for UK, decelerating from 3.9% year-on-year in April. So that is the expectation for May, a further deceleration in trend. So something to look out for, 2 p.m. Singapore time. Then thereafter, we do have a rather quiet session today because the US session is closed for the public holiday. And early tomorrow Asia session at 9:15 p.m. there'll be a release of another key benchmark interest rate from China. So very likely the PBOC will maintain the loan prime rate, both the 1 year and 5 year at 3.45% and 3.95%, given the fact that the 1 year MFL rate was remained unchanged yesterday. All right, so that is the today's key data to point to look out for in terms of economic data releases. So with that, I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.